Listen to me. IAS 20 isn't an accounting standard. It is a trap designed by bureaucrats to see if you can read the fine print. We call it accounting for government grants, but let's be honest, it's sugar daddy accounting. The government gives you a pile of cash and you think, jackpot, I'm buying a boat. Stop it. You cannot touch that money. You cannot sniff that money. You cannot even look at that money until you are absolutely certain you will comply with the conditions. It's like a first date who pays for the lobster but expects you to help them move a dead body later. If you recognize grant too early and fail the conditions, the auditors will look at you with that judgmental stare usually reserved for people who microwave fish in the break room. Do not be the fish guy. All right, geniuses, let's talk about grants related to assets. This is when the government feels sorry for you and buys you a shiny new machine because you're too broke to afford it yourself. Now, IFRS gives you two choices on how to account for this freebie, and frankly, both are annoying. Option 1, you treat the grant as deferred income. You put the cash in a liability jar and slowly drip feed it into the P&L over the life of the asset. It's like eating one slice of pizza a day for 10 years. It's painful, but it's disciplined. Option 2, you deduct the grant from the carrying amount of the asset. This is my favorite because it's basically lying. You buy $1 million machine, get a $500,000 grant, and tell the balance sheet the machine only cost $500K. It shrinks your depreciation expense instantly. Just remember, if you sell that machine later, your profit calculation is going to be weirder than my search history. Okay, wipe that smile off your face. This is the area where it all goes wrong. We are talking about repayment of grants. This is what happens when you promised the government you'd hire 50 people, but you just hired your nephew and bought a foosball table. Now you must give the money back. Accounting for this is the financial equivalent of the walk of shame. If you netted the grant off the asset, you increase the asset's value back up. You must admit to the world, hey, remember how I said this machine was cheap? I lied. It's expensive again. You also must catch up on all the depreciation you missed while you were living in fantasy land. It hits your profit and loss statement like a freight train loaded with bricks. It destroys your margins. It ruins your bonus. And worst of all, I must explain it to the board. If you trigger a repayment, don't come to my office. Just go straight to prison.